Welcome to Capitalists versus Consumers, where we break down how money really works and show you how to start building income that works for you. Today, we are covering one of the most misunderstood topics in investing: options trading. If you have heard the term options and felt confused or intimidated, you are not alone. Most people either think options are only for Wall Street professionals, or they jump in without understanding what they are doing and lose money quickly. Today, we are going to change that. We are going to break down exactly what options are, how they work, the key terms you need to know, the most common strategies, and the risks every beginner must understand before placing a single trade. Quick note before we get into it: everything we cover here at Capitalists versus Consumers is for educational purposes only and not financial advice. Options trading involves significant risk and is not suitable for all investors. Always do your own research and consult a qualified financial professional before trading options. Please hit the like button and subscribe so you never miss a report. Let's get into it. What is an option? An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price before a specific date. Let's break that down word by word because every part of that definition matters. A contract. Options are not stocks. When you buy an option, you are buying a contract. Each standard options contract represents 100 shares of the underlying stock. The right but not the obligation. This is the key distinction between options and futures. With an option, you can choose whether or not to exercise it. You are never forced to buy or sell. At a specific price, this is called the strike price. It is the price at which you have the right to buy or sell the stock regardless of where the stock is actually trading. Before a specific date, this is called the expiration date. Every option has an expiration. After that date, the option is worthless if not exercised. The two types of options: calls and puts. There are only two types of options, and understanding both is essential. A call option gives you the right to buy a stock at the strike price before expiration. You buy a call when you believe the stock is going to go up. If the stock rises above your strike price, your call option becomes more valuable. A put option gives you the right to sell a stock at the strike price before expiration. You buy a put when you believe the stock is going to go down. If the stock falls below your strike price, your put option becomes more valuable. Here is a simple way to remember it. Call: you are calling the stock to you. You want to buy it. Put: you are putting the stock away. You want to sell it. Key terms: every options trader must know premium, the price you pay to buy an options contract. If you buy a call option for $2 and each contract represents 100 shares, your total cost is $200. That $200 is your maximum loss if the trade goes against you. Strike price: the price at which you have the right to buy or sell the underlying stock. If you buy a call option on Apple with a strike price of $200, you have the right to buy Apple shares at $200 regardless of where the stock is trading. Expiration date: the date the contract expires. Options can expire weekly, monthly, or at specific dates throughout the year. After expiration, a worthless option goes to zero. In the money: an option is in the money when exercising it would be profitable. A call option is in the money when the stock price is above the strike price. A put option is in the money when the stock price is below the strike price. Out of the money: an option is out of the money when exercising it would not be profitable. A call option is out of the money when the stock price is below the strike price. Most options expire out of the money and worthless. At the money, when the stock price is approximately equal to the strike price. Intrinsic value: the portion of an option's price that reflects how in the money it is. A call option with a strike of $100 on a stock trading at $110 has $10 of intrinsic value. Time value: the portion of an option's price that reflects the time remaining until expiration. All other things being equal, an option with more time until expiration is worth more than one expiring soon. This time value decays as expiration approaches, a concept called theta decay or time decay. The Greeks: options traders use a set of metrics called the Greeks to measure how an option's price changes relative to various factors. Delta measures how much the option price moves relative to the stock price. Gamma measures the rate of change of delta. Theta measures time decay. Vega measures sensitivity to volatility. You do not need to memorize these for this introduction, but knowing they exist helps you understand why options prices move the way they do. How options actually make money. A real example. Let's walk through a concrete example to make this tangible. Suppose Apple stock is trading at $200 per share. You believe Apple is going to rise significantly over the next 30 days, maybe because of a product launch or earnings report coming up. You could buy 100 shares of Apple for $20,000. If Apple rises to $220, you make $2,000, a 10% return on your $20,000 investment. Alternatively, you could buy one call option contract on Apple with a strike price of $200 expiring in 30 days. Let's say that option costs $5 per share, or $500 for the full contract of 100 shares. If Apple rises to $220, your call option is now worth at least $20 per share, because you have the right to buy Apple at $200 and sell it at $220. Your $500 investment is now worth $2,000 or more. That is a 300% return on your $500 investment, compared to the 10% return on the $20,000 stock purchase. This is called leverage. Options allow you to control a large position with a small amount of capital. But here is the other side. If Apple stays flat or falls below $200 by expiration, your call option expires worthless. You lose the entire $500. With the stock purchase, you still own the shares even if they fell. You have not realized a loss unless you sell. Options amplify both gains and losses. That is the double-edged nature of leverage. The most common options strategies. Now let's cover the most widely used options strategies, from the simplest to the more sophisticated. Strategy number 1, buying calls for bullish positions. This is the most basic option strategy. You buy a call option when you believe a stock is going to rise. Your maximum loss is the premium you paid. Your potential upside is theoretically unlimited. As long as the stock keeps rising, your call keeps gaining value. Best for traders who are bullish on a stock and want leveraged upside exposure with defined risk. Strategy number 2, buying puts for bearish positions. You buy a put option when you believe a stock is going to fall. Your maximum loss is the premium paid. Your profit increases as the stock falls below the strike price. Put options are also used as insurance, a strategy called a protective put. If you own 100 shares of a stock and are worried about a short-term decline, you can buy a put option as a hedge. If the stock falls, your put gains value, offsetting some of the loss in your shares. Best for traders who are bearish on a stock or investors who want to protect an existing position against downside risk. Strategy number 3, covered calls for income. This is one of the most popular options strategies for investors who already own stocks. Here's how it works. You own 100 shares of a stock. You sell a call option on those shares, giving someone else the right to buy your shares at a specific price. In exchange, you receive the premium immediately as income. If the stock stays below the strike price, the option expires worthless, and you keep the premium as profit. If the stock rises above the strike price, your shares get called away, sold at the strike price, and you still keep the premium. Covered calls are a way to generate income from stocks you already own. Many long-term investors use covered calls to effectively lower the cost basis of their holdings over time by collecting premium month after month. Best for investors who own stocks and want to generate additional income while holding them. Strategy number 4, cash-secured puts for acquiring stocks at a discount. This strategy involves selling a put option on a stock you would like to own at a lower price. You receive the premium immediately. If the stock falls below the strike price, you are obligated to buy 100 shares at that price. But since you wanted to buy the stock anyway at that level, this is not a problem. If the stock stays above the strike price, the option expires and you keep the premium. This strategy allows you to get paid while waiting to buy a stock at your target price. Best for investors who want to acquire a stock at a specific price and are willing to be paid to wait. Strategy number 5, spreads for defined risk and reward. A spread involves buying one option and selling another option on the same stock, either at different strike prices or different expiration dates. Spreads reduce the cost of entering an options trade by using the premium received from the sold option to offset the premium paid for the bought option. They also define both maximum profit and maximum loss. A bull call spread, for example, involves buying a call at a lower strike price and selling a call at a higher strike price. You pay less upfront than buying a naked call, but your profit is capped at the difference between the two strikes. Best for traders who want limited risk and defined reward rather than unlimited upside potential. The risks. Every beginner must understand, options trading is not for everyone and the risks are real. Here is what every beginner needs to understand before placing a single trade. Most options expire worthless. Studies consistently show that approximately 70 to 80% of options held to expiration expire worthless. This means the majority of people buying options lose the entire premium they paid. This does not mean options are a bad tool. It means buying options without a clear thesis and risk management is a reliable way to lose money. Time decay works against option buyers. Every day that passes an option loses some of its time value. This is called theta decay, and it accelerates as expiration approaches. If you buy an option and the stock does not move quickly in your direction, time decay will erode the option's value, even if the stock eventually moves where you expected. Volatility affects option prices significantly. Options prices increase when market volatility is high and decrease when volatility falls. Buying options when implied volatility is very high, such as right before an earnings report, means you are paying a premium for that volatility. Even if the stock moves in the right direction after earnings, the decrease in volatility can cause the option price to fall, a phenomenon called volatility crush. Leverage cuts both ways. The same leverage that turns a $500 investment into a $2,000 profit can turn that same $500 into zero. Options beginners often underestimate how quickly options can go to zero. Assignment risk for option sellers. When you sell options, through strategies like covered calls or cash-secured puts, you take on the obligation to buy or sell shares. Understanding when and how assignment happens is essential before selling any options contract. How to get started with options. If you want to start learning options trading, here are the practical steps. Step 1. Open a brokerage account that allows options trading. Most major brokerages, including Fidelity, TD Ameritrade, and Charles Schwab, offer options trading. You will need to apply for options trading approval. Brokerages have different levels ranging from basic strategies like covered calls to more complex multi-leg strategies. Step 2. Start with paper trading. Most platforms offer a paper trading feature where you can practice options trades with virtual money before risking real capital. Use this extensively before trading with real money. Step 3. Start with the simplest strategies. Covered calls and cash-secured puts are the most beginner-friendly options strategies because they involve selling options against stock you already own or cash you already have. They are lower risk than buying naked calls or puts and give you a chance to learn how options work in practice. Step 4. Learn continuously. Options trading has a significant learning curve. Books like Options as a Strategic Investment by Lawrence McMillan and online resources from the Chicago Board Options Exchange, cboe.com, are among the most respected educational resources available. Step 5. Manage risk strictly. Never risk more than you can afford to lose on any single options trade. Many experienced traders limit options trades to a small percentage of their overall portfolio precisely because of the leverage involved. The bottom line on options trading: options are powerful tools when used correctly. They can generate income from existing stock positions, provide portfolio insurance against downside risk, and offer leveraged exposure to stock movements with defined maximum loss. They can also be a fast way to lose money when used without proper understanding, particularly for beginners who underestimate time decay, overestimate their ability to predict short-term stock movements, or trade options on volatile stocks right before earnings. The key is education first, paper trading second, and real money only after you have a clear strategy, defined risk parameters, and genuine understanding of what you are trading and why. Options are not gambling, but they can become gambling very quickly without the discipline and knowledge to use them properly. That is a wrap on today's breakdown here at Capitalists versus Consumers. If this gave you a solid foundation for understanding options trading, please hit the like button. It helps more people find this content. Subscribe and turn on notifications so you never miss our weekly breakdown every Friday after the close and our daily after the bell market report every trading day. We will see you in the next one. Resources mentioned in this video: Options as a Strategic Investment by Lawrence McMillan, The Options Playbook by Brian Overby, Options Trading Crash Course by Frank Richmond. This video contains affiliate links. I may earn a small commission at no extra cost to you.